Hey guys, welcome back to the Web3 Daily. Today, there's just one word to sum it all up: breakout. Bitcoin smashed past 118K, Ethereum clawed its way back above 3K, and Memecoins and altcoins are on a full-blown rampage. Volumes exploding, and we're back to that classic regret if you sell kind of energy. Bitcoin isn't just pumping in price, it's also seeing huge flows from US institutions. BlackRock, Fidelity, and even Grayscale are shuffling positions. OTC quotes are rising fast, signaling that big money is seriously stepping in. Ethereum's lagged a bit behind but finally broke 3K. With zkEVM upgrades and proto-dank sharding getting traction, developers are flooding back and activity on-chain is picking up. Translation? Projects smell the bull and they're waking up. Memecoins, absolute madness. DOGE, WIF, and PEPE all trended on X yesterday, especially on Solana where some coins doubled in hours. The whole sector's moving like it's got something to prove. But real talk, if you're thinking of jumping in now, this is not the time to ape in blindly. When Bitcoin pauses even slightly, altcoins tend to retrace hard. Early in the cycle, bravery wins. Midway, it's about speed, but in the end, it's your strategy that keeps you alive. The biggest drama in the crypto world right now, FTX straight up telling Chinese users, sorry, you're not getting your money back. And yeah, the internet's on fire over this. Here's the deal. The FTX liquidation crew just filed a motion in court asking to exclude users from 49 restricted jurisdictions from getting any payout. That list includes China, Hong Kong, and Macau. The reason? Local laws prohibit crypto. But get this, Chinese creditors make up 82% of that group, with claims totaling 380 million. Sounds a bit targeted, doesn't it? People are furious. Imagine this. You passed KYC, submitted all your claims, followed every rule they gave you, and now you're being told you get nothing because of where you live. Meanwhile, FTX had no problem taking your money back when it was all sunshine and rainbows. On X, Chinese KOLs and lawyers are calling this what it is: theft wrapped in legal jargon. Some users are even talking about organizing offline protests. Others are sharing horror stories of millions in losses and years of savings gone in smoke. Legal experts are weighing in too. One US bankruptcy lawyer said this might violate basic principles of creditor fairness. Even other bankrupt crypto firms like Celsius and Voyager managed to compensate users from China. So what makes FTX so special? What's really insane is that they're not just refusing to pay back the money, they want to absorb it into a trust fund. Translation, your cash becomes their war chest. They get richer, you get nothing. This is shaking the industry hard. First, it's eroding trust in centralized platforms. If where you live means you're cut out of compensation, that's terrifying. Second, it's pushing people away from CeFi and back to self-custody. And third, it's exposing the gap between what regulation is supposed to do and how it's actually being used to screw users over. TLDR, FTX isn't just breaking hearts, they're breaking the damn rules. And if this gets approved, it sets one of the most dangerous precedents the crypto world has ever seen. First big headline, Bitcoin smashed through 118K, and it's not retail driving the move, it's the institutions. Big boys like BlackRock, Fidelity, and MicroStrategy are pouring in billions, and even Grayscale is restructuring to keep up. June alone saw over 3.7 billion in net inflows into Bitcoin ETFs, basically stealing the spotlight from half the traditional equity market. This isn't dumb money, it's strategic, deliberate buying. Look at BlackRock's entries. They're nailing the bottoms and pushing to new highs every time. That's not FOMO, that's conviction. Bitcoin's officially been upgraded to digital gold status in the eyes of Wall Street. And the metrics back it up. We're seeing volume spikes, record high on-chain activity, OTC desk premiums, and a big surge in USDT minting. That means fresh money's actually coming in, not just empty pump action. Technically, BTC broke its all-time high without even a real pullback. Analysts are now throwing out 130K and even 150K as next targets. Sounds wild, but if you look at past cycles, this is exactly when things start to go vertical. But not everyone's eating. Altcoins are lagging hard. Most of the money is either in blue chips or meme plays. Mid-tier tokens, dead silent. If you're stuck in illiquid small caps, you're watching this rally from the sidelines. Bottom line, Bitcoin's become a battleground for institutions. If you don't know the rhythm, don't try to dance. This is not the time to jump in blind and get caught as exit liquidity. Second big story, XRP is back in the spotlight and making serious noise. We're talking about a triple play that's got Wall Street, crypto, Twitter, and even TradFi suits paying attention. First move, ProShares is launching the first ever XRP futures ETF going live next week on CME. That's huge. After Bitcoin and Ethereum, XRP just became the third major crypto to get institutional ETF access in the US. Now funds can get exposure without worrying about custody, lawsuits, or SEC drama. Result? XRP spiked over 27% in a day and volume exploded. Second move, Ripple's going for a US national banking charter. Yeah, not just some crypto license. They want full-blown bank status. If approved, Ripple would be able to offer bank-grade services with XRP at the core. That's next level legit. It means compliance, regulation, and yes, access to the Fed. Third, Ripple teamed up with BNY Mellon, the world's largest custodian, to hold reserves for its stablecoin, RLUSD. That gives the coin serious credibility. XRP isn't just a remittance token anymore. It's morphing into the backbone of a new kind of financial network, regulated, integrated, and programmable. And on-chain data confirms the hype. Whale wallets are growing fast, money's pouring in, and the community's buzzing. This isn't just a narrative pump, it's a full-blown market reprice of XRP's long-term potential. That said, caution still matters. XRP's been a widowmaker for years. If you didn't load up at the bottom, don't go full FOMO at the top. Timing matters, especially with coins that move this violently. Third story, Hong Kong is rolling out the world's toughest stablecoin license regime, and it's already become a bloodbath. Over 40 firms are lining up to apply, but insiders say only 3 to 5 will actually get the green light. Starting August honest, if you want to issue a fiat-backed stablecoin in Hong Kong, you'll need a full license from the HKMA, and this isn't some checkbox formality. We're talking strict capital requirements, redemption frameworks, full audits, AML compliance, and background checks on your entire team. It's regulation with teeth. So who's in the front of the line? Big players with real credentials. Think Standard Chartered's JV with Animoca, JD Technology, and Ant Group's blockchain arm. These guys have the financial muscle and regulatory track records. Meanwhile, most crypto-native teams, they're not even close. Why the frenzy? Because this license doesn't just give you regulatory cover, it gives you access to banks, payments, rails, and government-led cross-border pilots. This isn't just Web3. It's infrastructure-level financial tech with real-world use cases. But don't get it twisted, this isn't going to be an open field. Just like with Hong Kong's crypto exchange licenses, the HKMA is being ultra-selective. Binance and OKX already withdrew their VASP applications, knowing they couldn't meet the bar. Same thing will happen here. Bottom line, this is the opening bell of the stablecoin arms race in Asia. Whoever lands a license first becomes the reference point, and everyone else gets stuck playing second fiddle. Fourth story, GMX just got hit with a 42 million exploit, and the culprit? Good old technical debt. The attack targeted GMX on Arbitrum, where the hacker used a crafty sequence of contract calls to drain the liquidity pool. Assets stolen include 10 million in Frax, 9.7 million in USDC, and a bunch of ETH and wrapped BTC. Classic DeFi ninja stuff, quick cross-chain transfers, obfuscation, tornado cash, mixing the whole playbook. GMX moved fast. They froze VONE trading and halted GLP minting. Redemption right away. But here's the kicker, 2's been live for months, yet VONE was still operational for compatibility reasons. And just like that, the window stayed open long enough for someone to break in. The team offered a 10% white hat bounty if the funds are returned. But let's be real, no one who scores 42 million walks away for 4.2M unless they're about to get doxxed. Impact? Immediate. GMX token tanked 28%, TVL dropped hard, and trust across the DeFi space took another punch to the gut. This isn't an isolated case. Kyber, Prisma, and now GMX protocols are getting smoked, left and right. The root problem? Legacy contracts with no audits and no shutdown plans. Everyone's racing to ship V2s and V3s, but they leave VONEs hanging. And guess what? Hackers love outdated code. Bottom line, if your project still has unaudited legacy contracts in the wild, you're basically a walking exploit bounty. DeFi doesn't forgive sloppiness, especially in a bull market. Fifth story, ADA is making an unexpected comeback, surging over 30% in 2 weeks as whale wallets go into full accumulation mode. Why? Two big catalysts, the upcoming midnight airdrop and rising hopes for an ADA spot ETF. Let's break it down. On-chain data shows whales holding 10M to 100M ADA ramped up their positions, adding over 1.2 billion ADA worth more than 900 million. Active addresses also spiked to a 2-month high. That's not just whales, it's the crowd getting back in. First, the airdrop. Midnight is Cardano's upcoming zero-knowledge privacy sidechain. Think of it as a zk layer for enterprise use compliant, private, and scalable. ADA holders will get night tokens based on a snapshot, so whales are front-running the drop hard. Cold wallets are waking up, and the buy pressure is real. Second, the ETF angle. Analysts now peg the odds of an ADA spot ETF approval in the US next year at over 90%. Why? Because Cardano's architecture is similar to Ethereum, but it's viewed as less likely to be classified as a security. With the SEC under pressure post-XRP ruling, there's a clear pivot away from forcing crypto into outdated regulatory boxes. ETF eye pulls big money. If ADA gets that stamp, it's not just a pump, it's a full revaluation. That said, Cardano still has problems. Weak DeFi, low TVL, and limited developer traction. Midnight might fix that, or it might flop. This rally could be a real breakhooter, just an airdrop trade in disguise. Bottom line, ADA's back on the board, but the ecosystem needs to deliver or this momentum won't last. Sixth story, Ethereum is going full beast mode. The foundation just announced a roadmap to bring zkEVM directly onto Layer 1. This isn't a Layer 2 patch, it's a core architecture shift that could redefine Ethereum as we know it. Here's the play. Instead of every node re-executing every transaction, Ethereum blocks will eventually be verified using zero-knowledge proofs. One proof confirms everything. It's faster, lighter, and insanely more secure. But the goals aren't just performance, they're about decentralization too. The ZK proof system must generate in under 10 seconds, use hardware that costs less than 100K, and consume under 10 W of power. Translation? You don't need a data center to participate. A regular PC should eventually be able to run a proving client. The rollout will be phased. First, ZK clients run alongside traditional ones. Then, if things go smooth, Ethereum will make ZK verification mandatory for all nodes. If that works, we're looking at a full ZK-powered loan by 2026. Why does this matter? Because if Ethereum nails this, it nukes the whole "my chain is faster than yours" narrative. High TPS, low gas, instant finality. Ethereum will have it all, plus the most battle-tested ecosystem in the game. But let's be real, this is hard. zkEVMs are black belt cryptography. You've got circuit design, proof generation, validator incentives, client diversity. It's basically rebuilding the plane mid-flight. Bottom line, this isn't just an upgrade, it's Ethereum betting the house on being the OS of the new internet. And if it pulls it off, the rest of the chains better buckle up. Today's market didn't whisper, it screamed. Bitcoin's breaking records, Ethereum's rewriting its foundation, XRP is gunning for regulatory royalty, ADA's staging a stealth breakout, FTX is ghosting Chinese users, and DeFi just got hacked again. Every headline is pushing you to decide, are you playing or are you just watching? If you're in, don't get greedy at the top or scared at the bottom. Bull runs reward rhythm, not recklessness. If you're still on the sidelines, don't chase "there's always another play," but know whether you're chasing gains or dodging bullets. Will tomorrow be crazier? Maybe. But the real market isn't made by candles, it's built on human decisions under pressure. So stay sharp. Even in the heat of a rally, clear heads print the fattest gains.